Hello traders, Gary Wagner here, approximately 9:15 in Honolulu, 3:15 in New York. It is Friday, finally, last day of the week, last day of the month, August 31st, 2012, and this is the daily report for gold and silver, our weekend review. And what a week we've had in the precious metals markets, capping off today with a tremendous surge to the upside after Bernanke's report following the Jackson Hole Symposium. We currently have, in terms of the markets itself, gold up over $32 on the day. As you can see, current print is around $16.90. That would put it up about $34 on the day. That is almost a 2% gain, with a low of $16.44 and a high, we're on the highs, at $16.90.50. Not to be outdone, the little brother silver is up almost 3.5%, a $1.9 rise, 31.63, with a low of 30.17 and a high of 31.65. What a phenomenal move in the precious metals markets today. Just simply unbelievable. I thought it'd be a much more neutral stance. The first chart that I want to look at, this is a daily chart, continuous contract of gold. Reason for me putting this up is we talked the other day about the fact that as long as gold, in terms of pricing, is going to maintain itself above the former resistance, this breakout point right in here, I felt we were headed higher. We talked about where I thought it was headed. We'll really cover that a little bit more in a second. I talked about the fact that I thought it was going to 1700. The fact that it's at 1691, I didn't mean yesterday that it was going to go to 1700 in a day. If I'm wrong, it's a great way to be wrong. But here's what I'm noticing. This is a quick observation, but I think an important one. When we go ahead and let's blow that up. And now when we look at this former resistance area right in here, there can be no doubt that the ability to use technical analysis in the market is going to not only help you, but give you valuable insight that you're just not going to get with a simply fundamental approach. Can't happen. When we take a look at this market, the fact that as this market came, and look at this doji, this is your breakout doji right here, open and close about the same, high and low. There's no gap in the market, no real gap, because it traded through that range. But once it traded above this particular breakout line, you can see that it did come down. And on 3 occasions on our daily chart, you can see that where we had lows at that point. But as I said all week, as long as we don't really trade into this area, we're good to go. And I really believe that, one, our long-term correction is probably over, and two, prices will continue higher. Well, where do I think they're going to continue to? As I said, we're looking at about 17 to 1705. That's my first point, my mark, and we'll look at a chart in a second that really conveys that, and we'll show you where we derive that information from. We are looking at a weekly chart, straight candlestick format, Elliott wave count, as well as our compression triangle and breakout. As time goes by, there can be absolutely no doubt that, one, we've genuinely seen a push and a breakout, and secondly, it gives us technical evidence that this long correction is finally over. Now, that being said, I'm not really expecting the market to move straight up. The first level of real resistance that gold could encounter, I believe, is going to be around 1705. And the reason for that, as you can see, this is a 23% retracement. It's a 23% retracement from this last long rally right in here. The shorter of the two retracements starts here, and then the longer, of course, is going to go back, and that's these numbers right in here. So that when we take a look at this particular market, there is the opportunity to find resistance right in this area, and it's based upon a Fibonacci number. This is also where we drew that extreme support at 1581 and gave us the confidence to begin to enter the market when most out there were looking for lower prices. technical evidence is critical, I believe, in properly trading the markets. Now, we're currently getting another breakout as we go into the close on the session, currently trading at 1693, 1694. So we are absolutely quickly approaching those target numbers. Let me bring that chart over for you. And as you can see, this is a daily chart. An incredible surge in the market right in here, 1693. This market continues and wants to trend higher. Of course, this is absolute pressure that's going on the dollar right now. We'll have to see where it wants to go. But as I said, my sentiment is if we're going to find some resistance, and I should say when, because typically you're not going to go parabolic, I would look for the market 17 to 1705. That's probably roughly in this area. This would be a target where we would look to either pull profits or tighten our stop up in case it wants to continue to run higher. We're just going to have to see. And of course, traders, a lot of this is dollar based. You can see we're looking at a Henkin chart, weekly Henkin chart, yet another week lower in the US dollar index. For those of you who watch my daily report, not just the weekend review, you know that my take on it right now is that we're probably going to channel within this particular set of resistance and support lines that were created by using a modified pitchfork. Traders, I only really have two words for the silver market: amazing and wow. Incredible surge, upside surge within the silver market today. For those of you taking my daily, you recall that the last 2 days, as this market has been under pressure, this is a 360-minute chart. I said, and I'm paraphrasing my own statement, but we can go back and listen, but that this level, without a doubt, should absolutely hold in terms of support, 30.21. I put that number out based on this Fibonacci 23% retracement, and the retracement level is from this last major move up, 26.94 on the low, 31, call it 22, 25 on the high, 23% retracement in line with the market moving up and Elliott wave theory. And now these last couple of bars, you can see without a doubt, have absolutely gone parabolic. I mean, these are straight up bars. Now, it's made it through what I would have looked at as our potential resistance, because I was also looking at this as a potential resistance point. So traders, where's our next point of resistance? Let's take a look. Now, in terms of looking for our next level of resistance, I'm going to use a combination of straight Fibonacci retracements as well as just trend analysis itself, some areas that we can define. Now, one of the first areas that I see, I'm looking at as this market came down on this last run down, I'm looking at various tops in the marketplace. As you can see right in here, we have a top right in here. And those to me would seem to be logical points. At the same time, this top also corresponds to a 61% retracement, and that 61% retracement is of this rather large move here. So, straightforward, where am I looking at resistance? Well, $32 is the first place that I'll look for as possible resistance, and that's really just based upon the series of tops that we see right in here. You can see that as the market came down, it goes back up and it cannot take that out, comes here and it finds support right in this area. Of course, we've surpassed that area. We have surpassed this level. So really the next market is going to be $32 in terms of mild resistance. Major resistance, 33.14. That's right in here, and that's our major resistance area in terms of where we'll see silver go. Now realize, when you take a look at the kind of move that we've seen, this would be in terms of a minor count, 1, 2, 3, 4, and then our fifth. Our fifth will probably take us up anywhere between 35 and 36, but it's falling right in line. There's some great potential here in silver. Traders, this has just been an awesome week. We've got some very lucrative positions. For those of you who took my advice when we saw the market weaken last week on Wednesday and added to their positions, you guys are making out like roses this week. It's just been a great week for all of us. This has been Gary Wagner, wishing you, as always, good trading. We certainly got it this week again. We'll talk to you on Monday for another daily update and review. Have a great weekend, 3-day weekend for us. We'll talk to you on Tuesday. Bye-bye. excited about what we are seeing in the market. If you recall, 2 and 3 weeks ago, I was talking about the potential for the market breaking out hard to the upside. We've actually seen that. So I kind of want to go back, take a look at what it is that gave us those clues, and then most importantly, at the end of this, I want to be able to forecast where we think gold might in fact be headed over the next 3 to 6 months. As you can see, we're looking at a basic bar chart, open, low, high, and close. It is a weekly chart of cash gold, currently trading 1674, 1675. It's just beginning to trade for the start of this week. First thing I want to do is to simply convert this for us into a Henkin chart. And as you recall, it is a form of Japanese chart that really takes into account the midpoint of the prior day. So it gives us an idea of trend or lack of trend. So we'll go ahead and do that. Now, once we've converted this into our Henkin chart, I think that you can see quite easily that a lot more information becomes available to us, visual cues to let us know what the market's doing. You can see that on these uptrends, as we've talked about before, they can be identified really by a consistency or a continuation of solid green bars. And the same thing with the downtrend. You see these red bars and you get a consistency in there. In the same way, when the market is in a consolidating area or it's in a congestion area, you really get these alternating patterns where you really have no real defined trend, but it's easily identifiable because you're getting these alternating candles. Now, with that in mind, when we take a look at this chart, and I'm going to go ahead and blow that up for us a little bit so that we get an idea of what we're looking at right now, you can see quite easily that as this market, this is our record top, 1920 here, market comes down, it makes a series of lows. You can see these lows right in here. And as the market came down, the first climb that it had took us just to about 18, I believe 1802 or 1803. It comes down, it makes its secondary low, comes back up, and of course, it stalls right in this area, comes down. And this is where we talked about the fact that it is really forming a strong base in the area. And why did we say that? Well, when we take a look at these series of lows right here and right here, you can see that as this market came down, although it wasn't able to come back up and make new highs, that as it came down and touched these lows, support came into the market, buyers came into the market, and were able to propel the market back to the upside. Another thing that is quite apparent is as we look at this chart, there really can be no doubt that we were really in a kind of consolidating period, because when we look at it, you can see we have small-bodied candles and they alternate from green to red, back and forth. However, we saw something change recently. And when we take a look at what happened really at the beginning of August, you can see in terms of the Henkin chart that itself, you started going into straight green again. And look at the body sizes of these candles. Look how they have really expanded and grown. Those were the first indications, but the real clue to why we were looking for a breakout at a certain point can be identified with two things. One, Fibonacci retracement, and then the second thing is basic pattern or trend analysis. Now, simply what I have done is as follows. I have, in attempts to identify support and resistance levels and breakout points, put up two Fibonacci sequences. The first is our longest sequence, going from the beginning of this rally, which is 2008, all the way up to the record top. The second one that I'm using is this bottom right in here, about October 2010, after climbing really to about 1250 and retracing pretty hard back to about 1150. This is also a significant area. So we take it from there, that beginning, all the way up to the top. What you'll notice is what is simply known in the industry as Fibonacci harmonics. A Fibonacci harmonic is where you get two different sequence times that reveal the same number. In other words, the 23% level and the 38% level of these two different sequences, these two different time cycles, both point out a critical critical area, and that is somewhere between, call it 1620, 1627. Right in here, it's looking at about 1623, 1622. Now, when we draw a line straight across, the first thing that you're going to notice is that you get a series of tops. This has been really strong resistance. So when the market came down, every time it came up to attempt to go and fight out to make these highs again, it would be stalled right in this area. For that reason, 2 weeks back, I talked about the fact that what I was looking for to get some kind of technical evidence that we were going to end this correction, first of all, and secondly, have a pretty powerful breakout, was the fact that we needed to see the market break above that point. You can quite easily see that once it did, it broke out, and it broke out very hard. Now, all I have done here is converted our Henkin chart back into a standard candlestick chart. Still a weekly chart, same chart. The reason for doing that is that we don't really get true bodies in terms of where it opens and closes when we look at the Henkin chart. The only way to do that is to go to a candlestick chart, because on the candlestick chart, the open is the bottom of this rectangle and the close of that week or Friday's close is the top, and it gives us a different kind of visual cue. The first thing is when we look at the same target point, 1622, it's even more apparent in terms of the type of resistance that we had in this area. And most importantly, you can see this clear and utter breakout once the market did bounce above this point. Tremendous candle size in terms of the high and the low range, takes us into new territory, and most importantly, it finally breaks above this area right in here, this resistance area. Now, to me, this is where it really begins to get fun, because once we take that information and we add it to a couple of other techniques which we've talked about, one, the compression triangle that you see here, and secondly, Elliott wave and Elliott wave forecasting tools, we're able to identify some new information and put it all together, and that's what's going to really allow us to do our forward forecasting to where I think this market is going to go, say over the next 3 to 8 months. And here's what I'm looking at. The first thing is we have to determine at what point is this long correction that we've witnessed over. And in Elliott wave, we have identified a series of waves. The series of waves, we talked about this a couple of weeks ago, begins at the conclusion of C. This is their major count. I call it the long count. And on our long count, we had wave 1, wave 2, wave 3. We are currently in wave 4, although it's my belief that this is the technical evidence that we finally concluded that. If in fact that's correct, it means that we are going into wave 5, and it's a major fifth wave. That is really exciting news because of the following. When we do forecasting models using Elliott wave, there are a couple of techniques that we use. Simply put, one of the easiest techniques to use and most important techniques to use is called wave 1 benchmark technique. And what that means is that we simply take a look at the move that we saw in wave 1. This is wave 1 right here. And wave 1 is going to attempt to predict what kind of correction we should see in wave 2. And then when we go to wave 3, the one thing that we can say is that wave 3 cannot be the smallest of any of the impulse waves. Waves 1, 3, and 5, of course, are our impulse waves. So we would know that wave 3 would be at least this distance in terms of price move. We had our correction. This has been a tremendously long correction, as you can see, taking us to the conclusion. This is wave 4. And then what is wave 5 going to do? Well, typically in Elliott wave forecasting, wave 1 and wave 5 are looked to be equal. However, that's not the case in gold. And in gold, when we take a look at the intermediate counts, it's been typically wave 5 that has been the largest of the moves. So we're going to use a couple of tools to do our forecasting. The first thing is we're going to say, if wave 1 and if wave 5 are about equal, where in fact would that take the price of gold? To do that, rather than doing a Fibonacci retracement, we're going to introduce a new tool, and that's called a Fibonacci extension. Simply put, on a Fibonacci extension, what I'm doing is I'm measuring the price move from the beginning of wave 1 to the conclusion of wave 1, and then I'm carrying it over to the low or the beginning of our fifth wave and forecasting where the market's going to go. Based upon that knowledge, this is the following conclusions that we reach. This is simply a Fibonacci extension, and it's an extension of wave 1, so that if wave 5 is equal to wave 1, we should see this market go into new territory anywhere between 2,000 and 2,100, right in that area. However, if wave 5 is larger than wave 1, we look at different levels, 123%, 138%. Again, we're using the same Fibonacci numbers as we do on retracements, only we're doing it for an extension. So my belief is that this next rally, and I'm not talking short term, I'm talking a longer term major count, should take gold well above 2,000, anywhere between 2,050 to maybe 22 and a half, based upon the fact that we are just looking at it in comparison to wave 1. Last week I did something different. I allowed viewers who wanted a little bit more information a place on my website to go and get an extended view. In the case of last week, I had an extended seminar that I put up. This week, what I'd like to offer Kitco viewers is the opportunity to look at an extended, more comprehensive view of Elliott Wave. For those that are interested, as you can see, I've put up my website address on the screen along with a screen print. You see the little box, the green box there. Simply click that, and that will allow you to use and view the extended Elliott Wave tutorial. Fibonacci retracement, Elliott Wave.